Welcome to episode 20 of the PetroNerds podcast. I am your co-host, Ethan Bellamy, here with Trisha Curtis, the CEO of PetroNerds. We've got three good topics today. First, we're going to talk about the market as usual, and then it's a special field trip episode as Trisha talks about her trip to Midland, Texas, as well as showing up to the Liberty Oilfield Services Investor Day, home of the Happy Valley Frackonomics. I'm a big fan of a really good 3D render and a thought like that. So without further ado, we're going to dive in. Trisha, let's talk about the market first. $100 oil, are we there?
Yeah. So let's just hope this recording setup works, because that'd be really exciting. So we'll ask our guests or our listeners to forgive us for video and audio on this test run. But yeah, so before we get into the super fun field trips, which were awesome, and I do love being in the field. So $100 oil. Look, we're at $73 today. I can't help but talking about the market. I think that, Bank of America has called for 100. It's really easy to call for 100, and it's really easy to call for higher oil prices when prices keep going up. And I do think that, the Fed's, the fact that, Jerome Powell came out last week, and we had the folks get nervous in the market, and then this week it sort of was calmed down after his testimony. Bullard had come out, a Fed member, and others basically saying that they're looking to raise rates in 2022 as opposed to 2023. All that didn't actually impact oil prices as much as I thought it would. And certainly there are a lot of analysts and spectators that agree with me that, we should have seen, with the nervousness and hesitancy on inflation, and with also the dollar moves, that we should have seen oil pull back. It hasn't really pulled back. I think part of that's just because the momentum is in its favor. And there's something to be said about momentum trading and traders sort of bidding this up. So I think we're seeing a bit of that. And I think it could be somewhat of a self-fulfilling prophecy. If folks want to take this higher, they can certainly take it higher. There are a couple things that I've heard lately. Like, if you're staying up and you're watching the markets, is funny because I hear these things like 2008 and 2013. And they're like, oh, look, this is like the indicators that said we're going to 100. And I'm like, and then what happened after 2008 and what happened after 2013? Prices crashed, so I think that if we're going to 100, we're coming back down. So I would be a little bit more nervous. And I guess, Shell and Chevron and Exxon have all said, look, oil prices are going higher. And that's great to an extent for these oil companies, but it's not good for the consumer. It is not good for long-term demand. And I think I think you'd heard it. The Saudi oil minister was at a conference a couple weeks ago, and he had made a comment when talking about this being a super cycle. He had said it's his job to make sure it's not. And I thought that was really interesting coming out of the Saudis. But it's also important. I mean, you've seen the numbers, right? The OPEC numbers. And I keep telling this. I've got friends texting me all the time at oil companies saying, and I say, look, this one's different because OPEC production is different. So demand, yes, ramping up. I'm confident. We're seeing that in everything. We definitely saw some bullish numbers out of the US, but OPEC numbers for May for total OPEC production is not even 25.5 million barrels per day. They're shy of 25.5 million barrels per day. Now that's like about 400,000 barrels a day higher than the month prior. So we did see Saudi Arabia increase output from 8.1 million barrels per day to 4.7 million barrels per day, roughly, just under that. So you got to remember, the last time we saw prices, when did we see prices high and when did they crash? We definitely saw OPEC production, particularly Saudi production. Saudi production, in 2018, before prices cratered, was probably pushing, between 11 and 12, and was probably sort of in that 11.5 million barrel a day mark. We're talking about 8.5 million barrels a day right now. So they are absolutely 100% keeping, barrels offline and keeping this market tight and constrained. And as you've seen, and probably lots of listeners have seen, they're selling everything off. I mean, they're going to the bond market, they're going crazy, they're doing all kinds of things. And that's, if I was running the kingdom, that's what I would be doing too. Let prices get a little high, sell things off, sell assets and stakes and pipelines, and then go about your business. So to me, I just think this is not a normal market in which that I do think the Saudis have an incredible amount of, they have an incredible amount of control in that they've withheld these barrels. And should they want to bring them back, they can bring prices down easier.
So what do you think OPEC's spare capacity is now? And is that the biggest reason why we wouldn't have sustained triple digit prices? Because I think one of the theses that's driving the market is, there's spare capacity, but if you push forward some trend lines, we could run out of spare capacity from OPEC. And also, just as an aside, I think the Iran nuclear deal is close to completion, and that looks like the ability to bring a few more million barrels back on the market as well.
Yeah, so both those are hugely relevant. I think the other piece of this is that I think so. It's like people saying we won't have enough spare capacity when we need it, which we don't need it now, or we would be using it. We will have a shortfall of investment, and the whole Iran thing. Now, the reason partly why oil is $73 a barrel right now is because we don't have a deal with Iran. So Iran did elect their hardliner. Shocker. They have a hardliner in place, but that's not the person that's doing the Iran deal. So that's, we haven't actually even been at the table for the Iran nuclear deal. We actually have diplomats on either side actually doing the negotiating stuff. And we're not nearly as close as I think a lot of people think. And that's why we have $73 oil. Now that's traders probably getting ahead of themselves, but I do think the Biden administration wants to do this deal. The problem is it's not looking good for Biden. It looks like he's going to look pretty dovish on Iran if he goes through with this, because he's not getting much in return. He's getting kind of a hope that, hey, we won't build a nuclear, we won't build a bomb with all this nuclear enrichment that we have, or this uranium enrichment we have right now. So that's helping keep the market inflated. That uncertainty right there is certainly helping prices. And I think that was the biggest backdrop against the dollar sort of looking a little bit better with potential that we'll raise rates in 2023. And then that aside, I think the shortfall of investment, and I always say this, it does make me nervous because, I think everybody wants to talk about us we're going to have a shortfall of investment. Nobody's going to invest and oil prices are, oil prices going up now is not a result of a shortfall of investment. So today, the oil price increase we have now is not a result of shortfall investment. Those things are being a little bit conflated. So I'm assuming people think we'll have this the rise immediately to $100 a barrel is not going to be shortfall investment either. The U.S. producers being very slower to ramp up the rig count is not a shortfall necessarily of investment. So I think globally we have to be careful. The old school oil guys tend to say shortfall of investment.
Yeah, it's a shift in financial policy, right? I mean, it's this new E&P paradigm of living within cash flow that investors have pressed upon them, which thus far they look committed to.
Right. Well, but I think we have to be, and we can talk about that when we get into the Liberty thing, but you can look at the rig breakdown in the U.S. And so I think, come back to the OPEC thing really quick. If we're looking at Saudi Arabia at 8.46, 8.47 million barrels per day of production right now, we know they can easily go to 12 million barrels per day. So at the end of the day, you can bank on at least 3 million barrels a day spare capacity. I am not worried about spare capacity. And then we also know that, this whole Iran thing is that Iran has added 1 million barrels a day of production in basically the end of last year to now. So they did that all while under sanctions, all while increasing the uranium enrichment. So they can probably add another 1 million barrels a day back relatively quickly, but they're bringing these barrels back. And I do think the only concern for OPEC really, for the Saudis and their control is that everybody wants to bring barrels back. They're going to want to increase these barrels. So how long can they sort of keep this? And it seems like they have been able to keep decent continuity doing their monthly meetings, and also just because it's worked. Oil prices are up, so people seem happy. Now on the U.S. side, I caution this because I think it's where people point at the U.S. and then they say, okay, that's where we're going to have a shortfall of investment. And certainly, if you were looking at Shell and you were looking at Exxon and you were looking at Chevron, you're looking at what their shareholders have done to them, or the Dutch court ruling and what's happened with Exxon and Chevron from a shareholder perspective. Yeah, I don't think you can hold those into your portfolio anymore, whether you're a generalist or whether you are you're managing a portfolio and you say, I want some oil in that. I don't know if those are the best stocks anymore because I don't think they're representative. So those guys are probably, not indicative of everything. But if you break out the rig count, over half are private companies. And that rig count, we're at, we're 470 rigs according to Baker Hughes total. Now, Enverus will say we have more, which is important to take that into account. But let's just say 470 total as of the 18th of June. Now, 373 of those rigs were oil, 97 of them gas. If we rewind this to the beginning of April 3rd, 2020, we had 378 oil rigs and we had 465 total. So we are back to where we were in April. And look, they're continuing to go higher. And you can't, looking at the rig count is not a perfect indication of production. And there's a lot of nuances on the frac side and everything. But it's important that the rig count can't keep going up and production is just going to stay flat. That's not going to happen. And two, really interesting is when those privates are the ones that are driving that rig count growth, they are the drill folks, okay? They are the ones that are going to drill and complete those wells and bring on production. So
they are not living within cash flow like the public E&Ps. They are free.
It's a whole different world for these privates and everything. And the things are hot and the money is good. And, they don't have lots of different types of constraints. I'm not saying that right now everybody's making money unless they're just spending really, really poorly. And you don't have the service cost inflation just yet that we've had before. So now is the time. If you're public or private, you should be going gangbusters. So I think that's that will hit the market. We certainly aren't going to see the U.S. Below 11 million barrels per day. Exiting the year. So I just caution are we going to be back to 13 million barrels a day? No way. But are we declining? No. And are we, OPEC has gotten it wrong before. I'm just saying 100 or 200,000 barrels a day higher than they think, yeah, those are real. That's not a ton of crude, but it's not like, we're still the largest oil producer in the entire world by far. I will note that, Russia's at 10.75 million barrels per day, and that doesn't include, I believe that they say that's liquids. I think there's more on top of that with condensate. So look, Russia may not want prices to get too hot either. So they're a whole nother piece of this of trying to eke out production. So this whole shortfall of investment thing is a little off. And trust me, what's the signal been, what do you think the signal has been to, the U.S. shale producers? It certainly has not been, hey, slow down, folks, 73 WTI. Not a first chance in hell. Even if you're a public, the thing you're managing is ESG and investor pressure and all that crap. But if you're private, you're not sitting idle.
So it seems like the natural outcome here would be more public companies buying more private companies, like we saw with the Double Eagle transaction, where if you've got public companies that are flat to maybe moderately growing, you've got private companies going gangbusters and building up these big PDP bases with aggressive drilling, that naturally, that if you need growth as a public company, you got to go buy these small guys. If
you can as a public company. So if you think if that's favorable, frankly, you should, you're better if you're private. You don't have all this pressure and you can actually produce oil and gas that the market is demanding and you're producing it. So, it is Shell making the comments, and we probably need to dig into that deeper in a later podcast, but Shell making, having the whole Dutch court ruling, appealing it, but then making the comments, hey, thinking that they may consider exiting the Permian. Of course, there's a lot of folks public.
Yeah, that's $10 billion worth of assets, roughly.
Yeah, it's huge. Now, and that makes, the world is sort of going to come to a reckoning. BP is saying they're going to, divest or spin off or something with their Rumalia field in Iraq. And Iraq's freaking out right now because BP is a huge producer. BP has a massive position actually in the Middle East across the board. So whether or not they put that into a private company and they're not putting that in their GHG emissions, we know that when they divested the assets in Alaska and it went to Hilcorp, we know that their GHG emissions probably increased and those are no longer disclosed private company. That's 100% going to be the case, especially in Iraq, because a lot of that gas is flared. And so, we know that from a GHG emissions perspective, but probably from a methane and flaring and everything, we know that that's probably going to increase as they divest these assets. So I really think, if they are being true stewards, they need to take this into consideration. But there's just so much pressure, I think, from the ESG side. And now we will definitely, not on this podcast, but, what's happening within SEC and what, the pressure on thinking about, the way we're going to regulate these companies, especially all companies, to have these GHG emissions, that's going to get really, really messy, very, very tricky, very fast. But this is a component of that. We don't even have full disclosure from oil and gas companies on exactly what their emissions are right now.
Well, let's go to a lower emission fuel, natural gas. It's the summer of natural gas, $3.34 as we do this podcast today. Pretty fantastic result after years of, really anemic gas prices. The Marcellus, particularly with the delay in Mountain Valley Pipeline, looks to be export constrained at some point. You know, we've got a new bull thesis arriving on the Eagle Ford and the Haynesville because of proximity to LNG markets. What do you think about the gas market?
I think it's great. I mean, I've been bullish. I know you tweeted on Haynesville. Like, I mean, I've been telling people to get long Haynesville for a long time. Get long nat gas, get long Haynesville. We will certainly see prices come down from here. They could go up from here, but they will certainly come down. I don't think, you know, look at average Henry Hub US prices. It's between $2 and $3. Price spikes are great. You can certainly hedge that. But I mean, the market location, Haynesville is huge. There's a reason why Tellurian has the reason why they have driftwood in the Haynesville. There's a reason why folks want to have exposure to the Haynesville. And there's a reason why EOG is big on El Dorado, which is an extension of their Eagle Ford. The Eagle Ford asset is that it's close to market. You don't have these infrastructure constraints. You're not worried about, the Marcellus is great from a production perspective, but you're going to be capped out at, you have 2 BCF a day, probably less now, of pipeline growth, of left in your pipeline. So it's those plays are it. And so Texas, Permian gas, Eagle Ford gas, and we've recovered. The interesting thing is, look at gas production in the U.S. We've almost recovered to pre-COVID levels, and that's partly because you have technically older wells, and you're not increasing that. Your older shale wells you're hitting bubble points, you're increasing that gas, but it's also because gas is a smaller molecule and it produces easier, and we just have a lot of it. And so when you push on gas, and that's the other thing to be said about prices. Look, the moment you get excited about prices and people start drilling it up is the moment that prices come back down. So it's just one of those things. So just as long as you're comfortable with that $2, $3, $4, that window, and truthfully, it's really, how cheap can you get it on the water, and how cheap can you get it to Asia? And that's the story, and there are moments that you can make good money with that. But I think that's really important. I kind of liken LNG and gas very much like the oilfield service sector, which we'll get into shortly, of that. Look, it's the current standard and market we have today is probably not exactly how it's going to look in the future, but I damn sure believe that it's going to be there. I'm not concerned that we aren't going to be producing gas or exporting via LNG, but probably the exact structure we're doing it today and how we're financing these things might be a little bit different in the future, and probably needs to be to make money, but it's definitely something I would bet on.
Got it. Okay. Well, I don't want to get into it too much now, but would like to shout out to Raymond James, who has been talking about a very bullish propane thesis on potential supply-demand crunch. I think that thesis has some legs, and I would encourage people to take a look at the propane market and NGLs and investments centered upon thereof. So
yeah, we export on average we export about 1 million barrels a day of propane. I mean, propane is a big deal and probably needs to focus on, and we will circle back to.
We could do an all propane PetroNerds podcast. That'd be a good one. Yeah. So let's move now to your field trip to Midland, Texas, where you had a lot of interest on LinkedIn when you posted about your trip to Midland. And I'm not surprised you get a lot of traction on Midland and on LinkedIn, to be honest. But so tell us about that trip, why it was special, and more importantly, what you learned that can help people understand the energy markets better.
Yeah, I mean, well, I am a true nerd, so I want to be there and I want to see it up close. And I'll be honest, I mean, I'm embarrassed to say that I have not been to the Permian, and I'm okay saying that, admitting it, because I have, literally, my dad hadn't been to worked in Texas until he worked for Centennial for a little while a couple of years ago. He hadn't been there because he chased the oil booms around where we grew up. So he, Rifle in the 1990s, and the coal bed methane in Wyoming in early 2000s. And then obviously the Bakken, in 2008 when everything went crazy. So this was my first trip to Midland, and I was actually, visiting a client, and we just sort of were driving out in the field and taking looks at things. It was funny because the first thing you notice, it's like, I've flown into Bahrain, and Bahrain is a very tiny little country, and it's basically a whole oil field. You're on top of an oil field, and I felt like that's Midland. You're flying into Midland, and the coolest part, it's worth the ridiculously expensive United flight just to fly into Midland and see all the the actual locations. And you can see, if you're a true nerd and you're sort of studying it, of like how that's evolved, right? Where these are single well pads, and now you're getting to the point where actually, I think it was a former RSP field that we were driving by and looking at, and you can see where the pump jacks are massively consolidated as opposed to what you see when you fly in, and everything's sort of separate. So flying in was just awesome. But then you get to the airport, and it is the Midland International Airport. So that is an international airport.
Very international.
Yeah. So you see plenty of private planes, and it is busy.
So one question about when you're flying in. I used to always, I would make a trip to the Permian about once a year. And I always thought about the private jet parked ratio.
So I was just going to say, yeah, first thing I noticed, and I'm looking at everything, you know, when I see stuff, and I was looking at airports, and that I noticed first thing to my right in the window was the private jet sitting there. And then I also noticed, even when I went to dinner, of, you know, some foreign voices, you know, some foreign accents, some European accents and some Middle Eastern accents that were, you know, clearly had probably flown in on their private jets. And I think the guy had even said, you know, I'm exhausted, you know, this is my 24-hour flight or whatever. And I thought, man, and he's in Midland, which means they're making deals. So that's really real. So I noticed that for sure. And I noticed the airport's just busy. So this is, didn't quite think that the traffic in and out of Midland, and actually the immediate stuff around Midland, was quite as busy, and looked at some frac sand mines and stuff. Didn't see them quite as busy. But
Was your flight full?
What?
Was your flight full?
The flight was full, absolutely.
The flight was full, and the ticket was expensive. That's also
yes, absolutely. So flights packed, and that's United jacking up prices and everything. But flight was packed, and I haven't been on one of these tiny planes in quite a while, because I would be on them when I fly to North Dakota and everything for work. But so the tiny planes, and it's really funny because you're like, yeah, 3 women on the plane. Everybody else, you know, it's mostly, you know, male engineers flying into Midland from North Dakota and Denver, and, you know, and me sitting in by the window. Unfortunately, I'm tiny, but like these guys just having trouble, you know, normal sized guys just having trouble in these tiny seats. And I think they get really excited when they're sat next to somebody who's not this size of the same dude next to them, that they actually have some room with their arms next to me.
Well, so, sure, Trisha, even if you weren't pretty and I got on a Southwest flight, I'd try to sit next to you because you only take up this much of the seat. So
yeah, there's a huge benefit to sit next to a tiny girl. So yeah, I mean, just observationally, and you hear everybody talking. I mean, you're hearing everybody talking. The airport plane was delayed, so heard plenty of that. And then, you know, the traffic in and out. So I did see quite a few Liberty Oilfield Service trucks, you know, at the Midland Airport picking folks up. So you can literally see the activity from the airport. And then driving out, I think that's when I say it's like Bahrain, and then it's like an oil field. You're immediately seeing the pump jacks are right there. I mean, the moment you're on the edge of town is pump jacks everywhere. So I would say that, you know, they're equally as close to houses as, you know, the ones we see in the Denver-Julesburg Basin here in Colorado. That's just something as a way of life. But I'll also say it's extremely expensive. So there's definitely an oil price premium to this town of Midland. That's, you know, when I was in Richmond, Texas, visiting Chuck Yates, like those prices were beyond reasonable. And Midland is like you've flown into, you know, I would say actually food prices higher than Denver in some cases. So really expensive. Hotel is expensive, and definitely there's plenty of spaces open, you know, in hotels. So there's just kind of this premium. But I think the big takeaways were, you know, actually seeing some of these sand mines. And I do think, you know, we'll talk about it with the Liberty stuff because I was able to ask Chris Wright about it. But I think the actual, you know, the sand mine trajectory, you know, how busy things are. Like, look, we're at 470 total rigs. So we're not at the level we were, you know, when things were crazy, you know, in 2019. And so we're not at, you know, the real pre-COVID levels. And so I didn't expect to see this, you know, every sand mine going gangbusters. But I think that's the interesting thing is the service sector is that you still have a lot of entities in it, you know, that are not fully utilized. And that includes something like sand mines. So we drove by a couple sand mines, and that is...
Okay, so let's digress there just quickly, because I'm sure there's some people who haven't followed the change in how proppant is sourced and used. Because, you know, as a point of context, I was in, you know, Wisconsin detonating sand mines in 2012 and 13, and now that's out of the picture. So how has the proppant market changed, and what do you think the impact is on development economics?
Yeah, I mean, and for folks in the industry that are listening, I mean, they're well aware of the shifts from, you know, getting sand, you know, which proppant, but getting that sand that we mined in the Midwest. And it was partly because it was from a quality standpoint, largely from we kind of moved to the size being a smaller mesh size, but it was a lot of northern white 40/70. And and you can have bigger size proppant, 30/50, 20/40, all these sizes, but it's really
good sphericity.
Yeah. Well, so the quick switch over was basically, folks used to talk about, man-made proppant. So it was a man-made ceramic proppant that was very expensive, but it was almost a perfect sphere, and it was really very, very hard, had a high crush strength. So you can imagine just putting that down hole at 10,000 feet in the Bakken, where it's very hot, and you're trying to make a frac that, in theory, it has nice sphericity, so oil will flow around it. There's still quite a few theories, and actually when I was hanging out with the Liberty guys, we were talking about this, but still quite a few theories, I think, even on, I think it's like a frac religion or a completion engineer still believes in, certain types of proppant. The baby got thrown out with the bathwater, and typically prices are what dictate big changes and shifts that have in the shale revolution, because this thing started in 2008, prices crashed. And then, we've since had multiple prices going up and multiple price crashes since then. But really, that whole, if you even thought that you liked ceramics, that sort of the baby went out with the bathwater in 2014 when prices crashed. And if you thought you needed fresh water, that went out with the bathwater, we threw that out as well, because all of a sudden produced water was just fine. And so what happened was, and I talked about this in a big report I did with the Energy Policy Research Foundation when I was looking at actually things correcting looking at it in 2014 and 2015. Those were two big things. I mean, operators literally didn't believe it would work. They were literally using recycled produced water and crappy sand, whether they were getting it from the Midwest or they were getting it from somewhere else. They were starting to use crappy sand and pumping as much as they could downhole and hoping for the best. And that actually yielded good results. And so that started sort of the shift over of saying, oh, hey, we could probably do this. Now, what happened was an extension of, the last mile solution, thinking of just getting proppant, getting sand from the Midwest all the way to the Permian Basin. And remember that the Permian Basin was late to the party in the shale boom. So you had the Bakken and you had the Eagle Ford and you had, Denver Julesburg Basin and the Powder to some extent. And the Permian sort of matriculate, it's bubbling up the whole time, but it hasn't come to like real fruition. And we didn't even flip the vertical horizontal rig count, didn't even eclipse itself until actually 2014. So think about the last mile solution of how much money there is to be made and decreasing logistics and trucks on the road traffic in general and trains of having sand locally. And, folks realized that the sand, it wasn't the same quality as it is in the Midwest, but it was, this 100 mesh, which I am obsessed with and think it works really well. Very, very fine sand, like powder. Have a bunch upstairs that I should be showing you right now. But it's like powder. It's basically actually when you're in the Permian, you're scooping it off the ground. It is like dust almost. And you're pumping this down hole. And so once folks got comfortable with realizing this works, and UG was a big piece of this, because they were using this crappy sand long before they were choosing to use local mines or mines locally in the Permian before, when they owned mines in the Midwest, and they were still choosing to use this. So there was a reason they were doing it. And that reasoning was because they thought it was beneficial to pump this really fine powder down the wells. And we'll get into this with the Liberty stuff in their images and stuff. But the point is that all these things came together. And I've had lots of conversations with rail companies. I mean, I did a lot of work in my previous career with Burlington Northern Santa Fe and briefed their Shoreline Railroad conferences and everything. And I remember having these conversations of, this crappy sand will probably work. And nobody believed it. And it was like, well, some companies will stay with it. And I thought, once they realize it works and it's cheaper, they won't, because the cost reductions are so much. And so what's happened is that most of the Permian, the geology from from the sand perspective is fitting. It produces, your mine produces mostly 100 mesh, but it produced about 20% sort of 40/70. And really, though, when we drove by these mines, it's literally, you're just scooping up the sand on top of the ground, getting off the shrubs and stuff. And then you got this mine, you got the sand, and you're literally putting into these, these cleaners on the trucks, these basically silos and funnels. These trucks are going underneath it and filling up the truck. And those are going out to the frac sites. And that's your last mile solution. So you can imagine of just having that there, and then you're just driving it to wherever it needs to be. So,
and there are unlike in Wisconsin, there are no neighbors worried about silica dust that want to stop your mining project. project?
Well, I do think there's still concerns from there's still silica dust, there's still OSHA, issues and everything, but obviously less so, probably to an extent. And they have to handle those, but you're literally scooping things stuff and mining it. So I think from the real tech and nerdy perspective, when you're thinking about that and really thinking about the thousands of wells that have been done, and I was looking at, decline curves and everything yesterday and just normalizing it. And it is pretty impressive that every year we've improved a little bit in the Permian in terms of well performance. And even these current wells, we have a fraction of the wells that we brought on last year. And last year we had a fraction of the wells we brought in the year before. But they all have outperformed even when you're normalizing per lateral foot. And that is from scooping this really crappy dust off the ground and pumping it down hole. And that's largely slick water. That's very impressive. The fact that that's working, and also shows how, such early innings of this. But to digress, I guess to bring this back to sort of the Midland thing, all those sand mines, by the way, weren't fully busy. So they weren't fully operational. You didn't have 20 trucks lined up and hauling out. So that, it tells me that, everyone's just like any part of the business. All these companies are not created equal. Some of them might have better logistics. They might be teamed up better. They might have better guys on the phone, with their contracts and everything. And also sand has been decimated, right? When we had minus 37 WTI, the entire, suite of business from upstream to downstream was decimated, and the service guys including sand, were part of that. So we definitely had folks go under. And then, so do you have these guys come back, and you probably have more, obviously more supply than you need. And the other component is, I think we will see, and we've mentioned nomad proppant, but I think we will see local sand mining take place. And I did ask, at the Liberty Investor Day, I did ask about that, and it was, but I do think we will probably see it, and I do think it will have an impact on the space.
What do you mean specifically about that? Near the wellhead?
Yeah. So it'd be like, say, a big area that Exxon or EOG is going to mow down a specific area, that instead of, hauling from that, sand mine nearby, and EOG is probably not a good example because they still own their own sand, but other companies, they would literally be mining locally. And it is very different in that regard because they're scooping it up. They're probably not drying it out and then making it wet, putting it back. You have to have the technology. You have to have the capacity. You have to have the right frac technology to actually do that, to where you're staying wet and doing that. But, every time this industry evolves actually quicker than we think. And I think sometimes we think when we're analyzing specific, if it's the service sector, if it's sand, or if it's, operators, we sometimes get siloed in our thinking of how we analyze this stuff. And I think that it could move faster than we think. And, technology has a way of just jumping and figuring it out. If it can lower your well costs, technology usually comes, folks want to find a solution for that.
It is amazing how, we've gone from fresh water to produced water and from imported sand to local sand. Do you think there are any other areas of obvious efficiency or that someone's testing that are like that? I mean, water and sand is pretty much the components of a completion job. So,
well, I think we probably take for granted a little bit that, like, even flying in and seeing those well pads, I think we probably take for granted that, everybody's doing a 16 well pad, and they're not. We are just now the reason why people can actually talk about doing these simul-fracs or, fracking 2 wells at once. The reason they can even discuss that is because, folks now have on a consistent basis 4 well pads. And at the same time, we're also seeing, at least in the Permian, much longer laterals. We're seeing consistently when some operator says on earnings call that they're going past 2 miles, I can pull it up and look at in the data. And yeah, sure as hell, they're going past 2 miles, and in many instances, they're pushing that further. So when you combine all that of like the sand being local, drilling longer laterals and, having multi-well pads and doing that, people say this, analysts in New York and stuff, they say this, but probably hasn't been, I don't think it's at scale. And now we're sort of seeing that. So those are pretty incredible efficiencies and have, those have significant impacts on the market in terms of just how many manpower, men you need in the, men and women that you need in the field and actually on the ground. And I think we probably haven't seen that massive trickle in cost efficiencies, especially down to all these private operators. They may not be seeing that quite yet. So I think that's really big. Mining locally, literally at your well site, could be huge in terms of efficiencies. When we'll get into this with Liberty, but I think the simul-fracs are, whether it's you're actually using two sets of equipment and doing two frac jobs at once, even if you're doing that, even if it's two frac crews and you're just fracking two wells at once, and the speed of that, it's really about how fast are you fracking, right? How busy are those frac crews, and are they, not having downtime? I still think there's probably growth in that space. And drilling, I think it's fascinating that, we kept hearing even just pre-COVID, it was that, it was just harder to drill in the Delaware. And I used to hear that in the Powder River too. It's just so much harder. And, the Turner is below the Nio and it's deeper. And oh my goodness, it's just tough. Well, and I say that with a little lip service. It is hard. I'm not, trying to rip on drillers or anything, but it's amazing that, you can push past that and it's working, right? Drilling speeds have obviously improved massively, and interesting in every downturn, like just we heard in 2014, 2015, when folks couldn't use fresh water, or folks said they couldn't use produced water and they couldn't use crappy sand, and then they started using it. They also said, it's really hard to drill in Delaware, and, these wells are deeper and it's just hard. And they just didn't have that, maybe it was that they didn't have all the right drillers in place. And certainly we have more people available, people lost their jobs. And so you can get the right people in the right spaces. And we've seemed to get over that. The industry has seemed to be drilling faster and quicker and more efficiently in the Delaware, where it is deep, where it is thermally mature, and it can be harder to drill. So, we're seeing all those things, and all those incremental moves really they've certainly added up to benefit the operator and the producer and the exploration production company. They haven't quite benefited, I think, the service company. And that's really, Liberty Oilfield Services is a perfect example of that, of like one of the premier service operators. But they were very, very honest in their investor day of saying how much well costs have been reduced and how much, margins for them have not necessarily improved to that same extent.
Got it. Well, that seems like a natural segue for us to move into the 118-page Liberty Oilfield Services Investor Day on June 17th, 2021, where you went in person, talked to Chris Wright. And as a background, if you don't know, Chris Wright is an industry champion. He's an advocate of energy to alleviate poverty and air quality around the world in terms of LNG specifically. And if you flip through their deck, I would point you to slide 19, where they have a fantastic 3D rendering of what they call the Happy Valley, which is a 3D map of proppant mass, quantity of proppant versus the stage length versus your EUR, your recovery on the well, or your returns, if you will, which I think is great, because that's precisely the way to think about it. So good investor day from who I think is probably the leading champion, and also worth flipping through their ESG report, which was pushed out ahead of their investor day, where they take
it was on, I think it was, I have it here. Ethan and I will go through this in the podcast, because it is not your typical ESG report. It does have some cool stuff in it, but so they handed this out. This is worth, I think they put this out June 1st. And he is definitely taking a different approach, I think, on ESG, with definitely more about energy poverty and stuff. But we will have a whole episode where we talk at least to good extent on this.
Maybe we'll get Chris Wright on the show.
He's already said he's joining, so that's going to happen.
Great. Well, so let's talk about the investor day. I mentioned the Happy Valley. What else did you learn? What were your key takeaways?
Yeah, so one, it was really nice to be in person, and it was interesting because a lot of folks from the East Coast this was their first in-person thing, so everybody was super pumped. And that was I don't know if you tuned in for the whole thing, but it was all day. This was 9 to 4 p.m. and it was a full day event, and then happy hour afterward that lasted for a couple hours. So nothing was everything was covered from soup to nuts. And if you go through the slides, Chris Wright opens up with just the landscape. What does the oil and gas space look like in the U.S.? I would point out, and it is important to think about this, we mentioned it before, but I did ask him this question, and PetroNerds got a really nice shout out from Chris Wright, so that was pretty cool. But on slide 11 is the breakout of the rig count, and they specifically they give you this timeline, but they show how much is large caps, how much is mid caps, and how much are private. And basically over half the rig count is private. And that has a huge implication for the business in terms of, one, the rig count growth, and you can see how it's grown, but how the mid and large caps have flatlined. And then you can see it has big implications for the frac side. So just keep that in your back of your mind that that's an excellent chart on the rig count side. Their Happy Valley, is great. I think that one of the biggest takeaways from the beginning piece, at least for me, was the reduction in costs, and how much Liberty has said in many earnings calls, quarter over quarter, especially last year and the year before, the efficiencies that they have. So massive efficiencies in the space. And everybody would always say, analysts would always say, okay, have you tapped out on those efficiencies? And every quarter you kind of think you have, but then they would come out with more. And if you think about that as the whole service sector space of those efficiencies, it's pretty significant. So that comes to this point of they've seen a 50%, reduction basically in costs. And so when they have slides where they have this big uplift in production and they're explaining that, they can come to an operator and basically say, we can give you a 75,000 barrel increase in production in the first year if you let us tinker with, the frac design and stuff. And, and that's basically with larger, slick water, plug and perf jobs. So this is slick water and plug and perf. And this is part of that evolution from 2014 and prices correcting of what we've seen is the result is that we had sliding sleeves before. We used a lot of crosslink. We used, bigger, better sand, and we needed that crosslink. We needed that sort of gel and more viscous fluid to carry that bigger, denser sand. And then we realized that actually maybe we don't want to do that, and we can create more surface area and better contact. And so they did just the way they broke out and talked about, how long your frac is, from 200 foot to 2,000 foot in frac height, and how really you don't want that frac height, right? And you want to keep that closer to wellbore. But that's been sort of a very significant evolution in thinking. And that Happy Valley chart is really good because it's basically explaining, how techy you want to get versus your cost, right? And it's it's that perfect spot of basically they call it integrating engineering and economics to maximize returns. And that Happy Valley is that perfect point where basically you're getting your stage length and your proppant mass, and you're getting all your tech right for the right oil prices. And that sounds simple, but it's also when you're hanging out with the second day was a field trip in the field to actually go on the frac fleet, and talking with the engineers was awesome because it's something I've experienced, my entire career of talking with completion engineers is that none of them agree. So on how to actually, the exact way to sort of frac. And so there are charts that they show where they talk about, reduction in well costs and increases in performance, but they also show these, the techie stuff, which is, I think it's slide 36, starting on that. And then you get into these next several slides. And it's really about where are your fracs? So, simply, the order in which you're fracking wells. So understanding that order in which you frack your wells, and the fact that, fracs you want them to try to go around each other. So if you're fracking them in a certain order, if you're trying to reduce that frac height and you're trying to create more surface area and you're trying to create, altering your cluster spacing and your stage length, can all create these more complex, in theory, again, these more complex fracture networks. And I say in theory because if you talk to other completion engineers, they'll still say this is theoretical down hole. But slide 43 really shows that. Basically, what's the attempt? What are you trying to actually create and do? And that is the cool part because it means that you're, really, it comes down to how tight you can space these wells. What's the optimal spacing? And, if you can reduce that frac length and you can get these knots to communicate with each other, the timing of just when you put these wells together, and getting the spacing right, you're going to get more output. And that image, I think, is perfect on slide 46. And it's this Goldilocks of not fracking enough, fracking too much, and then fracking just right, of getting the spacing and everything just right. And that's a sort of game changing if that you can do that consistently right and get consistent performance. That's huge. And I think that's big for private companies. And then this whole thing on diverters, I'm not completely sold on diverters. I know that you'll hear EOG, talks about diverters, or at least there's rumors of EOG using a lot of diverters, and a lot of companies talk about use of diverters. We probably heard this come up pretty significantly in the past 3 years, pre-COVID, the use of diverters. And it's basically you can have far field diverters, near field diverters. It's thinking of like plugging off certain areas, to let your frac go somewhere else, or maybe not wanting your frac to go too far. And if you think about it from a really nerdy perspective of like where your frac is down hole, if you could actually apply that, if it works the way it does in theory, it could be very, very cool. I'm not quite, sold that it works out perfectly that way, but it must be working enough that folks are still playing around with it. So that's very interesting to me. And, we're certainly seeing it in, at least they're showing in the well performance of all these things taken together are actually working. And the fact that those costs have been reduced for the operator, it's really huge. But it does get to the question of, is the service company actually making money? And, I didn't ask that question. That would have been a little bit rude. But in the Q&A session, I did ask Chris about these private guys, and if these private guys were in fact using, Liberty, because they're, Liberty's selling a service that is premium, and they're selling all the suite of stuff. And, his answer was, hey, we've been working with the private guys for a long time. We don't just work with the big boys. So I certainly think they're in that space. But the reality is, look, if your private guys, if your chunk of the wedge is increased with them, I know they're not all applying this tech, right? I know that every private company is not doing this perfectly, which means we've got a lot of running room. If the wedge of these, if the private guys are pretty significant, in this portion of, they're looking like they're flatlining in the rigs, but let's just say they're the half of the guys drilling, there is a lot of technical growth that can be had with them because they're not all using Liberty Oilfield Services. And even more so, I think they're all, prices are high now, but these private guys are probably just getting to the scale, especially in the Permian, that they can sort of do this stuff. So I think from a technical capacity, there's a lot of growth there. And I think from production capacity, it is important for U.S. folks to be thinking about, and really OPEC to be thinking about, like, we're, whether or not we apply all this tech and all this capacity to every single well is one thing, but the ability to get more out of the ground, it's definitely there. I think we're, when you're on site and you're seeing this stuff, I think the ability to get more out of the ground is huge. Now, these guys making money. The other question I asked Chris toward the end of the day was on simul-fracs, because this is not it's not a well understood topic. Nextier has certainly mentioned it in their earnings call a couple times and really tried to break it out of saying, a simul-frac is not, I'm not talking simul operations, and which you can have wire lines and work over rigs and all kinds of stuff happening on location, but I'm talking about fracking fracking 2 wells with less than 2 full frac fleets. So whether that's 1.5 frac fleets, whether that's 1, whether that's 1.7, it's less men in the field, or less men and women in the field, and the actual frac crew, and typically less equipment. So you need double the equipment. And at least from my understanding, and I think Chris kind of teased this out, and you can listen to the playback, of that people may be hyping this up. And so it's not quite, one doing two wells at once. He was saying that Liberty has been doing this for a while, right? That Liberty has been doing simul-fracs, doing 2 wells at once, which in and of itself gives you massive efficiencies. But if you think about it from the perspective of not a full frac fleet, right? That it's 1 frac fleet, it's the main equipment, and then maybe you add, maybe it's a little more horsepower, or maybe it's, obviously you have more sand equipment and extra equipment there, and those types of things. If you're thinking from that perspective, it's still not, it's not 2. And I know that's happening today. I know that we do have lots of simul-fracking happening, not just in the Permian, but also in the Bakken, which means, we may not be counting, the frac fleets right. And that's important because, people are saying we have, 220 frac fleets. Well, are those 220 frac fleets, are they fully dedicated? We know that they're not. We know that they're not completely busy. And we also know that Liberty did a great job in their investor day of explaining to folks how you make money. And you make money by every minute you are fracking. And so you want to be fracking all the time. You do not want downtime. You want to be fracking 24/7. And so if you are idle, you're not making money. Well, that's a problem because we know those 200 plus frac fleets out there are not fully consistent, right? And we know in this business, if you followed it like I know, is that operators will have a dedicated frac for a little while, but then they'll say, no, we don't want this. And then they'll wait 2 months and then they'll bring it on. And this has been kind of this post-COVID weird lumpiness that we don't typically see. So that's pretty meaningful in that if we're also having this simultaneous operations, and whether it's 1 frac fleet or whether it's 2 frac fleets or something in between, it means that we're probably not counting those frac fleets right. And it means that we probably need more attrition in the space, and that, some frac fleets are probably better than others. And I just think it's very much, Chris Wright's mentioned it like the internet. And I've said this before, in my own analysis of that, the dot-com boom and internet, we had a lot of companies that, the internet did not die, but many, many companies did not survive or were even real. And pressure pumpers, UBS had that really great report on the frac side, which it was really, really good. And I think in the report, they said it's pressure pumpers are like cockroaches. They just keep popping up and they just never die. And even now you would think that you shouldn't have more pressure pumpers. You should not have new frac companies coming along, but you do. Like all of a sudden you'll just see a crew in Midland. And I hear this from clients, they'll just pop up and, pressure pumping because, the barriers to entry are you can just buy this equipment pretty cheap and you can just start up and you think you can do it. And when prices are this high, it's just tempting to do that. Now all of that and all the stuff I've been explaining all puts pressure on these guys on margins, right? That, how much money are they actually making? And that's why I say it's like LNG in that, they're certainly going to be able to increase their margins over time and prices are going up and we're seeing inflation and they're going to be able to go to the operators and bump these prices up. But they have not increased prices in tandem with oil prices for sure.
So it's a never-ending stop of efficiency and greater productivity, and the COVID pain just accelerated that.
I think it accelerated, but the interesting thing is I think people would have, if you were far out of this in the analytical community, you may have said, oh, we should see massive consolidation and this should just be done. And it just doesn't work. We have a very unique service. People always say, why did it work in the US? We have this very nimble service sector. That nimbleness that sort of enabled it, is kind of the devil's in the details. And it certainly enabled the industry to keep thriving, but it's painful right now, is in a transition space currently.
Dare I say that we have, at 51 minutes and 50 seconds, reached the end of a natural stepping point, if you will?
Absolutely. I will just say the field trip was awesome. Actually going to the field and seeing it. I've been on a rig, I've been in pump jacks, I've been in the field, but seeing the equipment from the frac fleet side and everything is, and actually because I'm so nerdy and I like to think about what's happening downhole, it is, if you're really studying this, it is so worth to see it because you think about it differently. And just thinking about the manpower, the equipment, everything, it's very impressive and totally worth seeing and super helpful from an analytical perspective in the business.
Well, thank you for another excellent episode, Trisha. Thank you to our subscribers. Please subscribe on Spotify or iTunes or YouTube and hit the like button because that helps us out.
And please, reviews. Lots of reviews. We like reviews.
And yeah, we like positive reviews. Trisha likes those 5-star reviews. So thank you for your time. This has been episode 20 of the PetroNerds podcast. It's June 23rd. We'll be back on our weekly cadence. Thank you for listening. Appreciate it.
Thank you. Bye, Ethan.